All right, folks. So what we're going to be looking at is the trade that I took on October 5th. Some of you wanted me to do a video to explain what I look into before entering, what do I look into while staying in a trade, and how I calculate my profit targets. So hopefully this video will be helpful. Let's get started. What I have over here is the daily chart here. This is what we were seeing on 10.5 pre-market on the daily chart. What I had over here was I was expecting long-term still short biased, but for an intermediate move, I was expecting it to come back to equilibrium, which is 38.74. So my bias was bullish coming in to on the 5th, and this is what the daily chart looks like, and that price range I have it calculated with the wicks, and that's how I got my 50% at 38.74 and 3/4. Now what I did also was just for the daily range of 10.4, I went and marked the price range for that day, and I found the equilibrium price at 37.47 and roughly 3/4. So I was having this. We were there during the market open. Carl, Lisa, and I were there, and I was telling them that, hey, I want 37.50 and below, more likely towards 37.47, get traded into before I try to look into a long. Now, why 50%, you may ask? This is sort of something that ICT kind of repeats himself several times over the videos, and in this case, on the 5th, if the bias was bullish, then we're looking at two things, or I was looking at two things. One is I wanted to enter a long at least where I thought discount was, right? It could have been that one single day range, or it could have been those two green candles together, but I at least wanted to start around 37.47 price range and then see whether it want to respect that or go lower. And then obviously the second one for a long is you want sell side liquidity to be taken out. And to give you an example, let's look at what ICT has to say. I'm going to take you to episode 27 from 4 minutes and 35 seconds onwards.
Rallies. I was not available during this time, so I didn't take any trades. As you'll see, there's no trades in this area. And then the retracement here in the afternoon, that's what I was looking for. So I wanted to see that type of idea. So I'm going to add the annotations to the chart now. All right, so here's the 5-minute chart. Here's the overnight London lows. 9:30, we run through it, taking out the sell side here, and then it starts to rally. All this rallying up here, I was not able to participate in. Market trades lower, down into the range between this low and this high. What is it trading to? Discount. So I'm going to go into this area a little bit tighter. Okay, so you can see here's a consolidation. It drops down, creates the low of the day, power 3. So it's accumulating long positions, manipulating early longs out of the market, taking out the stops overnight, then rallying, and then I'm looking for the continuation up to take out the relative equal highs here, because I think I'm still going to see continuation in the afternoon. So I want to buy this discount market, and I'm going to be buying inside of this Vega because it's at or below equilibrium between this low and the high. All right, so I've added the annotations here, and I got to adjust this because my obsessive compulsive disorder is flaring. It's like a spider sense, folks. Can't help it. All right, so we have the New York session open at 9:30 in the morning, New York local time. Creates the low of the day, rallies, creates the high here. At what time? What time is this candle here? It's 12:10. That's that lunch time. I told you it creates usually a retracement of some sort or consolidation. Then it retraces lower. And then here is 1:30, right about there. So at 130, the algorithm will start seeking liquidity. If it's going to continue higher, what's it likely to do? Seek sell side. So we're sell side. Well, we have relative equal lows here, but is that a discount from here to here? No. So this dashed line here that's in purple, I have that noted as equilibrium. That's essentially the same thing as taking the fib here to here, and that's 50%. Okay, so now we have equilibrium there. Market drops down into equilibrium, and then below it into the fair value gap here.
All right, so hope that audio was clear, but if it wasn't, just to give you a quick rundown, what he's trying to say is he takes the fibs from this wick here all the way to that one high up there, and this dashed line marks the equilibrium of that price range. So he's waiting for price to dip back below equilibrium because his bias is bullish so that he can attempt a long, and he's looking at uh, the profit to exit at the buy side liquidity because he's convinced that sell side liquidity was attacked after 1:30 p.m. Okay, so going back to my chart, um, I had that 50% drawn out, and then what I was looking at is okay, where would it want to go higher? So on my daily chart, I identified a fair value gap over here, and that is between the days of 920, 921, and 922. So this is 920, 21, and 22 daily candles. Okay, so I just had that marked to see that okay, it would potentially price range if the price cooperates. We're looking to for it to get drawn to this level here uh, into that fair value gap, that imbalance. All right, so now dropping down to a 15-minute time frame, this is the action that we were seeing pre-market. As you can see, what I did over here was I've drawn the 830 buy side liquidity, uh, the 37.78 and three quarters, where it was around the equal highs. And for sell side liquidity, I didn't really have like a level as such set. Like I said, I wanted it to be traded back into 37.47-ish before looking at um, entering, because by then it would have already taken out sell side liquidity on all these previous candles that you're seeing in this screen on the 15-minute chart. By then, definitely sell side liquidity is already taken. So just looking a little forward, here is the 15-minute chart again until the 10:30 a.m. 15-minute candle. Here is where I saw my confirmation. This is that green candle that I was talking about, that I first want to see a 15-minute, or when I was entering long, I wanted to see a green candle to show up on the 15-minute. Now, your obvious question is going to be, well, why the green candle? So let's talk about that. Why wait for a 15-minute green candle? Firstly, it's a conservative and waiting for confirmation approach. So what does that mean? Well, for starters, you're going to miss out on good trades. So be prepared for that. I'm prepared for that. It may not be something you may want, but this is something that I watch. Where did I get this from? I noticed in the ICT videos that whenever he goes long on a trade, the 15-minute candle is green. And likewise, whenever he goes short on a trade, the 15-minute candle is red. The issue that I have is, uh, you know, I'm while entering, I'm trying to make the anticipation that the current 15-minute candle will turn out to be green if I'm going long, or correspondingly, at 15-minute candle will eventually close red when I go short. So instead of me trying to anticipate what that 15-minute candle is going to close like, the color of it, I rather choose to wait for confirmation.
very simple. So this high here, draw that out in time, and you'll get this right here. Okay, but watch. With this run right there on a 15-minute time frame, what do you do with it? Well, you start stripping down from a top down 5 minute, 4 minute, 3 minute, 2 minute, 1 minute. So
So, if you got that narration, what you're saying in this episode 6 is that he's trying to enter short in this black candle over here, where you see that eye, where he's trying to say, hey, this is when an idea is getting formed. But as you can see over here, the black candle is formed on the 15 minute, which signifies that, hey, you want to be entering short there.
once you have this level on your chart on a 15-minute time frame, you drop down to year 5. Everything's transposed from the 15 to the 5 minute. You can see it trades above it here, and the market starts to trade lower. When it's trading low.
All right, so that example was from episode 6. Let's look at another one that he talks about going in long, where he points to a 15-minute chart from episode 7. So we're moving to an episode 7 now, where he shows a similar example. All right, so this is episode 7, taking you to 13 minutes and 33 seconds.
When we traded below, I went 1 minute candle. I'll show you in a live channel. Trust me. Just hear me out. Well, you got up here, and I took it out.
So what he's saying is he's bought it in a 1 minute chart of this 15-minute candle. Yeah, so hopefully you caught that, where he was trying to say that he went in long in this big uh, greenish candle that you see over here.
So this high here.
All right, so what I have done is I've shaded that green candle over here, because now we're going to drop down to a 2 minute chart, and you'll see this gray shaded range, and I'm looking to enter uh, after I see this green candle, which was formed at 10:30 a.m. So essentially I'm looking to enter the trade from 10:45 a.m. onwards. So this is the 2 minute chart. As you can see, this long uh, purple-ish color line, or cyan color, I guess. My wife would know the colors better. Along across the chart that you see is the 50% range that we were talking about. And as you can see, it dipped down into it. The gray rectangle over here is the 15-minute chart. And what I generally do is I take 50% of the price range after the market structure break has happened, as you can see on this 2 minute chart, around 37.45. Um, that I think would have been 10.28 ish candle. You can see the market. I mean that's where the swing high is, and then the market structure shift happens within that gray rectangle itself. So I've taken the price range of that, and the 50% level is around 37.41. So I'm looking for a fair value gap below 37.41. And as you can see over here, I've marked that with these two white lines over here. So I'm looking for a price below 37.39 and a half. So I go one tick right below that. 37.39 and a quarter is where I entered long. And if hopefully you guys saw episode 25, where I spoke about, hey, you want to be, when entering a trade, you look for the 50% mark in a specific price range to enter long, so that you're buying it in a discount. And then if you're entering short, likewise, you look for it to trade back into a premium. If you did not catch that in episode 25, I can play it for you over here. Let's watch that.
But we're looking for something very specific. In this shaded area here, we're looking for a fair value gap. Do you see a fair value gap? Some of you would say this. Yeah, I didn't know that. You're reading my mind, ICT. Why not that one? What would happen if I went into that and sold short? Well, first of all, if you did that, you would not follow the rules because from this high down to that low, this is equilibrium. We need to get to a premium. We don't want to sell in a discount. That's not what we're doing here. So we have to get to this level here, 40, 44 and a half or higher. That's a premium based on that price swing. Do you understand what I just gave you there? Like, that's a hardline rule that if you just follow that, it will keep you out of so many ill-fated scenarios.
All right, so hopefully you got that audio. What ICT was trying to say is he, in this shaded ray price action that you see over here in his chart, he's looking for it to trade back into a discount so that he can enter short. So finally, what I have here is my profit targets. I have my risk parameters set. Um, I risk $200, and as a result of that, it tells me what my position size is. If you guys want to know how, um, you know, I set my entries and I mean, sorry, how my position size gets calculated, I have posted other videos on my spreadsheet that I created for you guys and posted in the educational channel. Check out um, those videos and that spreadsheet in your spare time. But essentially over here, what I did was I entered at bought 7 contracts at 37, 39 and a quarter. And the first exit that I have was on this red line that you see, where it was entering a 2 minute fair value gap. And essentially, I was just trying to pay the trader over there. So I took off half my position, actually slightly more than half, for 20 points. And then my next level was at this blue line over here, which was the 830 buy side liquidity that I showed in the 15-minute chart earlier. That was the 37.78 and 3/4. If you guys remember from the 15-minute chart that I shared earlier, I took out one over there. Then another one I took out right under the whole number of 3,800. So I took it out at 37.99 and a quarter for 40. I think so that was 60 points. And then finally, the last buy side liquidity attack was at the previous day high at 3809. As you guys remember, I wanted it higher, which was the fair value gap on the daily chart. I was looking for 100 points. It didn't happen. After it traded into the previous day high and had the buy side liquidity attacked, I I think so. I gave it two candles to see if it would close lower, and then once that happened, I just closed it for 75 points at 38.14 and a quarter. So that's what I have on my price entries and exits and how I find my profit targets. Essentially, as you can see over here, is once the whole foundation or the whole gist of this story is that once sell side liquidity is attacked, we are essentially looking for buy side liquidity to be taken out over here and finally over here.